Hello everyone, welcome to the channel of Qianmo. In the last video, we talked about accounting depreciation. This video, we will talk about tax depreciation. In fact, while we are doing the accounting work for businesses in accounting firms, we normally keep two different depreciation schedules, one for accounting and the other one for tax. You must be thinking why? Well, tax tends to allow a more aggressive depreciation on the depreciation assets, especially for small and medium-sized businesses. In Australia, the law allows the immediate deduction of 100% of the value of some assets. This is one of many effective ways adopted by the government to stimulate the economy by allowing businesses to get access to the tax benefit sooner than later. Also because of this, the rules for tax depreciation changes often. As an accountant, it is important for us to know the latest updates. For example, due to the COVID-19, the recent changes have been increasing the threshold of the value of instant asset write-off from $30,000 to $150,000 and covers the businesses that have a turnover of less than $500 million, which used to be $50 million only for a certain period of time. Apart from the immediate deduction, there are other aspects in taxable deduction of depreciation that result in quicker deduction than accounting depreciation schedule allows, like pooling of assets. If you are interested in those rules, ATO's website is a good place to visit. This makes great sense in saving tax within where the law allows. However, from an accounting perspective, this does not represent the true value of the business's financial performance and the position. For accounting, the fixed asset register is supposed to reflect the true value of an asset at any time during its useful life. The cost of the asset should be spread across the asset's useful life to allow the correct reflection of how much that asset is spent in producing the income in any given period. Other than the distortion of the true value of assets that a business owns, depreciating too aggressively reduces the value of those assets on the balance sheet, as well as reducing profits on the P&L, thereby undervaluing the business. If the business is looking to borrow money from a bank or selling the business, this undervalue has a negative impact on the business's position. For those reasons, two separate depreciation schedules are prepared for businesses that require them. While on the financial statements, values calculated by the accounting depreciation schedule are reported. While preparing for the business's income tax, we use a worksheet called tax reconciliation to subtract the accounting depreciation and add in the tax depreciation to arrive to the taxable income or loss to be reported on the income tax return. Tax reconciliation is a worksheet that reconciles the accounting net profit or loss shown on the P&L statements with the taxable income or loss shown on the tax return. We will introduce in more details in future videos. Okay, that's all for today. Hope this video is useful to you. See you next time. Bye!